Okay, here we go. Welcome everybody to another webinar provided to you by optionslam.com. Get through quickly through the preliminaries here. Make the lawyers happy and the powers to be. Please read and understand the CFTC rule before you risk your hard-earned money in the markets. Our disclaimer tells you that we are not licensed financial advisors, nor are we registered investment advisors. Therefore, we do not provide investment nor financial advice, nor do we make investment recommendations. Therefore, everything you see in these webinars, including trade examples, concepts, ideas, charts, and risk graphs, are all for educational purposes only. And I am Marco, and this is my email address, optionslam.com at gmail.com. That's an easy one to remember. Love to hear from you. Please feel free to email me with your questions, your comments, and if you have suggestions for future webinars. Or any other suggestions you have, we're happy to hear from you. Today, we're going to get back into basics. The topic of today's webinar is about covered calls. And covered calls is oftentimes a trader's first introduction to trading options. In other words, most traders, general rule of thumb, start out trading in the markets or investing in the markets by buying stock. And then sometime later, they hear about this thing called options. And a very basic, and some might call it a beginner's strategy, at least it's one of the very first strategies that many option traders learn, is the covered call. Let's review what's on the screen here right now. This is right down to the basics, okay? Options, there's only two kinds. There's calls and there's puts. Calls, puts. You can only do two things with options. You can either buy them or you can sell them. Now, there's all kinds of combinations with options. And today we're going to mix in a combination that's not on the screen. Technically, it's buying stock and combining it with selling a call, which obligates you to sell the stock. When and for how much? That's easy. Anytime before or up to the expiration date of the option that you sold. And how much for? For the strike price of the option that you sold. So when you buy options, you have rights. You have the right to buy the stock, or in the case of the put, you have the right to sell the stock. On the other side of that contract, and an option is a contract, there are always two parties. There's a buyer and a seller. You can't buy an option without having a counterparty who's willing to sell it to you at some agreed upon price. On the other side of that contract is the seller. The seller is obligated to sell the stock in case of selling a call. The option buyer has the right to buy the stock at the strike price at or before the expiration date. Same is true with the put. So again, like I say, right down to the basics, and it's really good to remember, even for us more experienced traders, it never hurts to refresh. Oh shoot, I forgot to turn my phones off. Sorry for the interruption. Let me turn my other phone off here too. Okay, we won't get any more telephone interruptions. All right, so let's move on. So let's talk about a covered call here for a moment. A covered call consists of buying a stock, or you may already own stock, okay? If you already own stock, you can enter into a covered call because there's two parts to a covered call. Owning a stock and selling a call option against the stock, okay? I've got my slides sorted not perfectly. I really had trouble getting the slides sorted perfectly, so we'll just do the best we can with this. So here's an example. Let's say you own a stock that's trading for $100 a share. If 30 days go by and your stock is still trading at $100 per share, you're not making any money, right? So as a strategy, if you wanted to enter into a covered call, you would actually go out and buy the stock. If you already own the stock, you can enter into a covered call because you don't have to buy it. You already own it. All you got to do is sell the call. If you sell a call option at, say, a strike price of 105 with maybe around 30 days to the expiration date, you might get paid something like $2 per share. And if you owned 100 shares, that would be $200 you would collect for selling that call that expires 30 days out in time at the 105 strike. Now, here's what can happen. If the stock goes up to, say, $110, you'll be forced to sell your stock at 105. And you'll still keep the $2 per share credit that you got for selling that call. In other words, you will have participated, you will be up $7 per share instead of $10 per share had you just owned the stock. If you had just owned the stock and not sold the call, you would, and the stock goes up to 110, you would be up $10 per share, right? The thing is, in order to secure and lock that in, you would actually have to sell the stock, right? Otherwise, it's just a paper profit. Now, on the other hand, if the stock went down to $95 a share, okay, that would represent, I don't have a slide for this one, that would represent a $5 loss or a $500 loss in the case of a $100 stock. You got 100 shares and the stock goes down to 95, right? You would have a paper loss at that point of $500. However, if you sell the 105 call, you would have collected $2. The 30 days goes by. The call does not get exercised because it is out of the money. It expires worthless, and you get to keep the $200 you collected. So selling covered calls limits your upside risk, your upside participation in profit, but it protects your downside risk by the amount of premium that you collect. Any questions? Please feel free. In the stagnant trend, when 30 days goes by, you'll be profitable by $2 per share. This is back to, okay, you'll be profitable by $2 per share instead of breaking even, okay? So if the stock goes nowhere, stays at $100 for 30 days, you will have made $200. So this is why many enjoy covered calls, because they can still make money monthly, even in a flat market. Now, yesterday, we thought the world was going to come to an end, and today, we bounced right back. So I wouldn't call this a flat market. But we have seen flat markets, and we have seen congestion periods and consolidation periods after large moves, both up and down, especially in individual stocks. All right, so covered calls. Do you already own stock? Remember, option contracts control 100 shares of stock. Okay, one contract controls 100 shares. So if you own less than 100 shares and sell one option contract, you are not totally covered. You are only partially covered. If you own no stock and you sell a call, you are selling naked, not covered, naked. This is what we refer to as a naked call if you own no stock. If you own 500 shares of stock, for example, you can sell up to 5 calls. You don't have to sell 5 calls. You could sell 3 or 2 or 4. They would be covered. But if you sold 6 calls, right, you would have one that was naked. Selling naked versus covered. To sell one options contract obligates you to either buy or sell 100 shares of stock at the strike price, depending on whether you sold a put or a call. If you sell a naked put, you are obligated to have the stock put to you. In other words, you have to buy it at the strike price. If you sell a naked call, you have to provide the stock to the buyer of that option at the strike price. If you sell a call without owning the stock, you must go into the market, assuming the call expires in the money. Okay, let's assume the call goes to expiration date and it expires in the money. It has intrinsic value now. For example, in that same example where the stock was at 100, it went to 110, you had sold the 105 call, that 105 call would now be in the money. It's $5 in the money because the stock is up at 110, right? So if you sell a call without owning the stock, you must go into the market and purchase that stock at market value, in that example, 110, and then deliver it to the option buyer at the strike price. So you only collect 105 from the option buyer, but it cost you had to go into the open market and pay market price 110, thereby locking in a $500 loss. And this is in the case of selling a naked call. Whereas if you already own the stock, presumably at a lower cost basis, okay, so you may have bought that stock at months ago, years ago, at $90 or $80 or $70, or maybe you just bought that stock today at the $100 and then sold the 105 call. Okay, so kind of trying to think across a few different scenarios. If you own the stock already, you can fulfill your obligation simply by providing the stock. You already have it. You don't have to go in the open market to buy it. thereby locking in a profit and reducing your capital at risk. Because now that stock goes away out of your account, money comes into your account, you're locking in a profit, and at the same time reducing the amount of capital you have at risk in the stock market. There are times when we as investors and as traders want to do just exactly that. This is a risk graph of a short call naked. Okay? Typical P&L risk graph with a zero line showing anything, and the price of the underlying would be down here, going from 0 up to infinity over here, and simple, common, typical P&L risk graph, and where price is here tells us whether we will be profitable above the zero line, plus dollars profit, or over here where we will be if price is up here in this example of a short naked call, how much money we will be down, negative. This is a diagram of a short naked call. If I just sold a call only, didn't have the stock, not a covered call, this is the risk graph. So, why is earnings a good time to consider selling covered calls? And the answer is, it's all about implied volatility. IV, implied volatility, is elevated right before an earnings announcement. Generally, those last few days right before an earnings announcement is when implied volatility on your stock is going to be at its highest. You will collect more for your option selling at this time over almost any other time in the market cycle. Okay, Ted, I see your question, and we'll get to that. So, why you may want to sell a covered call? There's a lot of reasons why you might want to consider selling a covered call, and I certainly didn't think of all of them, but I jotted down a few here. You may think this market, or at least the market of your specific stock, is nearing a top. You think it's already high and can't go a whole lot higher. You may want to reduce your overall risk. You may have 1,000 shares of XYZ stock, and you'd like to lock in some profits and cash out of some of those shares. Selling a covered call against some of those shares is an effective way to do that and make money at the same time by collecting the premium. So rather than just closing, you could sell a covered call and collect even more premium, possibly providing you with even more profit. You may think that we are overdue for a correction, or that your stock is overdue for a correction, or the market in general is overdue for a correction. You may want to raise cash. You may want to reinvest at lower prices. Stocks go up, stocks go down. Prices are up, prices are down. Rather than just buy and hold, you may want to experiment with some market timing. Buy low, sell high, raise cash when markets are high, invest back into the market at lower prices. I took advantage yesterday of a big market sell-off, personally, and did some buying. You may think your stock is not going to have a good earnings call. In other words, you own stock and earnings is coming up here in a day or two, or maybe even today after the market closes, or tomorrow morning before the market opens, and you're concerned that your stock may not have a good earnings call, and therefore the price of the stock will go down. If that is your concern, that's a perfect time to sell a covered call, to get that downside protection. Rather than just watch the market go down after an earnings call, you don't want to necessarily sell your stock. You just want to get some protection against a downside move. Selling covered calls provides you with that downside protection. The risk is that you may lose your stock. Right? Because if the market goes up and it goes through your call strike, you are obligated to provide that stock to the option buyer. So this graph shows two scenarios simultaneously. The blue arrow shows the price of stock, the P&L of stock alone, okay? Just owning stock. Price goes up along this scale and profits go up. Price goes down below your purchase price of the stock and you are losing money. Whereas if you sell a call against that strike, and this is an example, Ted, of, if you will, take a look at this graph. This is an example of selling an in-the-money call against long stock. How do I know that? Because the zero line is right, the break-even point on this long stock is right here. Let's call this, let's just name that $100 per share, okay? Let's just say that, I don't have a scale down here, but let's say that's 100, and let's say this is 95, okay? You would have 100 over here, 95 over here, and et cetera, right? In this example, you could sell the 95 in the money strike. That would bring you $5, okay, of intrinsic value, plus another possibly, let's say, $2 more of extrinsic value, time value, okay? So this 95 strike might sell for $7, $5 of intrinsic plus $2 plus or minus extrinsic value. In this example, this is very likely to get called away. This is an in the money, selling an in the money call. Now you have your choice when you're selling covered calls. You can sell in the money, at the money, or out of the money. You can sell this 95 strike, the 100 strike, or the 105 strike, okay? In the money, at the money, or out of the money, okay? Depending, and this goes to your question, depending on whether you want to lose the stock is going to help you determine which type of option you want to sell, out of the money, in the money, at the money. This trader selling the 95 strike has a very high likelihood of having the stock called away from him, okay? He gets to keep the $7, the $700, okay? But does not get to participate in any more upside movement of the stock in the case of a good earnings event. However, has $700 of downside protection below the 95 strike, okay? Whereas the stock buyer has no protection whatsoever. All right, so hopefully that helps go towards that question. Again, option buyers have the rights, option sellers have the obligations. Now, notice that this risk graph is identical shape, okay? Picture that in your mind, and let's go back to the covered call, which is this risk graph, okay? Exact same risk graph. The difference between a short put and a covered call, a short naked put in this example, and a covered call is nothing as far as a risk graph. Your risk is the same in a covered call as it is in a short put. So that's why I would say to you, if you don't own the stock already and you want to engage in a covered call strategy, I would suggest that you would consider to just sell a naked put. It has the exact same risk profile as the covered call. The difference between a covered call and a short put should be, in my way of thinking, the trader's mentality and desire. Okay, so let me explain. In a covered call, the trader's desire or willingness to reduce the amount of stock he has in his portfolio and expose that stock to being called away is the mindset of a stock owner trying to provide himself some downside risk control and accepting the possibility that that stock could get called away from him, which would lock in some profit and reduce the amount of capital he has at risk in the market. Whereas if you don't own the stock, the short put trader really has a mindset that is quite opposite that of the covered call trader. The short put trader is theoretically willing to buy the stock at a cheaper price. So even though they both have the identical same risk graph, P&L risk graph, I think the difference is in the trader's mindset between the covered call trader versus the short put trader. I'm big on selling short naked puts myself, especially at earnings, and other variations of short naked puts, such as the short ratio spread. But in fact, I just had some stock put. I had actually quite a bit of stock put to me here just recently, this past weekend, because I had some options, some short put options expire in the money last Friday. And I had the choice I could have done a couple of things. And some stocks I did. Some stocks I rolled those short puts further out in time. But on several stocks, I thought, I'm just going to take delivery of the stock. And I let the short puts expire in the money, and the stock was put to me. So now I own some stock in 3 different equities that I didn't own before, just because the short puts expired in the money. So what happens is you sell an out of the money short put, right? With the understanding, or or possibly even the desire for that stock to go ahead and fall below your short put strike, and then have that stock put to you. You got paid some money to sell that short put initially, and then the stock gets put to you at the strike price, but your cost basis is the strike price minus the amount of premium you collected for that short put. So it's really a win-win. It's obviously a bullish strategy. All right, let's see. Okay, and that's it. That's all I have for today's slideshow, and I'll take any questions. While you guys are typing in questions you may have, we'll go over to the Thinkorswim platform, and let's go to, well, first, before we go to Thinkorswim, let's go over to optionslam.com, and let's see who's got earnings coming up. So I'm going to quickly go to the stock screener. Okay, under the earnings tab, I'm going to just see who's got earnings coming up here using my generic screener, which looks out 1 week from today. Stocks with weekly options that are trading over $20. And I get 31 results. Busy week. All right, so what do we have here? American Express, I see, I trade that pretty often. Capital One Financial, I trade that pretty often. A lot of these stocks I have traded. FCX is one of the stocks that I just took delivery on, that I was just talking about a minute ago. So let's see. And I've been selling naked calls on FCX forever. I've been selling naked calls on naked puts on FCX for a long time. And FCX has had a powerful run up. So I finally this time decided that I'll just take delivery of it. And so anyway, there's Honeywell, Intel, Johnson & Johnson. Is this Kinder Morgan? Is that what that is? No, Kimberly Clark. I'm sorry. Okay, lots of stocks. So who who's reporting here? Let's go by earnings date and just make sure that these are sorted by earnings date. I think if you don't click that submit button, sometimes it sorts by alphabetically here. So now I got them sorted by earnings date. So today is July 20th. These two stocks here have already reported before the market opened this morning. Okay, so let's take a look. We got United Airlines, and let's take a look at Netflix. It's a high price stock, though. Let's look at something that's a little more reasonably priced that we could all wrap our heads around as far as buying 100 shares, for example. Okay, you got Coca-Cola. Coca-Cola is a pretty low EVR, therefore it's not a huge implied volatility builder. Although anything over 1, you're going to see some kind of implied volatility build. What's this one? Seagate. Okay, Seagate Technologies. And I'm just scanning here. Actually, FCX is a good one to look at. Let's take a look at FCX. So, of course, for those of you who are new to optionslam.com, you can go directly to investigate FCX by, I like to open a link in a new tab right here. So I just right click on that and open link in a new tab. Otherwise, if I left click on that, I'm going to lose my list. It's just going to roll me into the FCX stock specific pages, and then I won't be able to refer back to my list. By doing it this way, right-clicking and opening in a new tab, now I can investigate FCX by looking at the earnings history page, trend analysis page, implied move weekly, implied move monthly, and the post-earnings pages, okay? So I have all those different pages I can go look at and learn about FCX and how it behaves around historical earnings events, okay? Here's historical earnings events. This is one of 8 pages, okay? So here's FCX. It sports a 2.3 earnings EVR, earnings volatility rating. It's going to be reporting before the market opens Thursday, day after tomorrow, July 22nd, before the market opens. So since I am an owner of this stock now, and honestly, I don't even know what my cost basis is, but it's since I've been selling naked puts for so long on this stock, I think that my cost basis is lower than where the stock is trading, but I haven't gone into my platform to add up all the money that I've collected in selling naked puts in the past. See, what happened with this stock, here I'll show you with the chart. What happened with the stock is, let's go to FCX. And the chart of FCX, as you can see, as I was selling naked puts, the stock kept going up and going up and going up, okay, until this most recent time, the stock came down and the put that I sold expired in the money, okay, so they put the stock to me. And but I had sold so many, I really honestly don't even know where my cost basis is. But let's just say my cost basis is right where stock is trading right now. Let's just say that that's what my cost basis is after having collected all those premiums. Now they're going to have earnings coming out. The stock has definitely had a hell of a run, okay? I might just consider selling a covered call against the stock that I own now. I only have 100 shares, by the way. I only was doing this in one contract at a time. Okay, so let's just assume that my cost basis is right here at 33.37. What could I do? Let's let's see. Looks like I already sold maybe I already sold a call against this. Yep, I already have a position in that. So I sold a call when I knew, I remember what happened. I knew this was when I made the decision to have the stock put to me, I just thought, I'll just sell a call against it. So I sold the call before it actually even got put to me. I sold the call last Friday, and I sold way out of the money because I kind of want to keep the stock. I'm not really looking to sell the stock. I'm still bullish on FCX, even though it's had quite a pullback. So that's why I allowed it to be put to me, and because I want to own it. Okay, and my cost basis is pretty low. So, okay, so looking at this, let's I'm hiding positions. And so therefore, what I can do here is simulate a covered call. Let's say I owned the stock and assumed my cost basis was the $33.32, okay? Just coincidentally, that's where it happens to be today. Or you could think of it as, if you wanted to enter a covered call situation, you could actually go out and buy the stock, spend $3,332 to buy 100 shares, okay, and then choose to sell a call against it, okay? So in either scenario, you own the stock already, or you go out and buy the stock, you can sell a call against it. Now, how long out in time? How far do you want to go out in time? And at what strike price? In the money, at the money, or out of the money? If you want the stock to be called away from you, the deeper in the money, the more likely that stock is going to be called away from you, okay? Generally, most covered call traders are looking at the money versus out of the money. I would say rarely do covered call traders want to sell in the money, because you're really not advantageous in collecting premium. The deeper in the money you go, the less time premium there is. So therefore, at the money is where you get the most extrinsic value. Selling the at the money strike is where you get the most extrinsic value. Okay, so let's say right now the stock is at $33.37. Let's just, if it were exactly at $33, right, this would all be extrinsic premium. It would all be time value. In this case, this is partially intrinsic value to the tune of 35 cents of intrinsic value, and the rest of this premium is extrinsic value. Okay, so what would that be? $2, what would be $1.65, $1.69 of extrinsic value, $1.69 of extrinsic value for the at the money, and then you go out of the money, and now you're only at $1.58 of extrinsic value. And the further out of the money you go, the less extrinsic value you're collecting. However, also, the less likely that stock is going to be called away from you. With an implied move of about $3.50, okay, approximately $3.50 based on the at the money straddle pricing, okay, with an implied move of about $3.50 based on the at the money straddle pricing. What am I looking at here? August 20th. Let me go to the front weekly just to see what the implied move is for this week. That would be about just under $2. Okay, just under $2 for the at the money straddle. So, okay, so choosing strikes, I might want to, if I don't want the stock to get called away from me, I might look to move out about $2, okay, up to the 35 or 36 zone to sell that call. And then in terms of, and if I definitely don't want the stock to get called away from me, then I'm going to sell something even further out of the money, okay? If I actually want to lighten my load and not have as many shares of the underlying stock, I would personally consider selling the at the money, not so much the in the money, because I want to collect that extrinsic value. I want to maximize the amount of premium that I'm selling. All right. Now, how about how far out in time? I like to gravitate to monthly options that are 30 to 60 days out in time. That's where I usually go, 30 to 60 days out in time, and I prefer to trade with regular monthly options. With this type of a strategy, there are other strategies where I trade weeklies, but with this type of a strategy, naked puts, covered calls, and the like, as long as there's good strike selection, and with this stock, there is excellent strike selection. As you can see, every 50 cents, excellent strike selection, even in the monthlies. Some stocks don't have great strike selection in the monthlies, right? This one happens to be phenomenal, right? Yeah, Wayne, I saw that. Wayne asked, do we have a Head and Shoulders for FCX? I did see that, Wayne. I noticed that too. You could argue that there is. Don asked, how do you use implied volatility percentile, IV percentile? Oh, okay, IV percentile. I think you're referring to, okay, so I think what you're referring to is found here in option statistics. And here is the current IV percentile is at 26%, which is not real high. Okay, it's not real high for FCX. The 52-week high is at 0.66. The 52-week low is at 0.44. And the current, and so we are at 25% between those numbers, okay? And Harold must be, I'm not sure what you're referring to, need to buy 100 shares. So, okay. All right, so let's go back to that risk profile now. And depending on, okay, so there's the risk profile of just owning the stock, okay, right? If you own the stock at 33, 32, and the stock goes up, you participate with a delta of 100, right? I would have a delta of 1, or in this case, oh, I have to change this to 100 shares. 100 shares of stock, maybe that's what Harold was referring to, probably. Okay, so owning 100 shares of stock, I would have a delta of 100. For every dollar the stock goes up, I profit $100, and for every dollar the stock goes down, I am in the red by $100. Now, looking at selling a covered call, and I would look at the money straddle pricing to indicate to me what the implied move is. And again, it's about $3.50. I could go up about $3.50 if to use that strike as a possibility. So that would be 33, 50 plus 350 would be $37. So I go to the $37 and sell a call against my long stock, thereby providing me a risk profile now that is capped. I can't make any more money once the price of the stock goes beyond 37. And as long as the stock expires on the 20th of August below 37, I get to keep the $66 premium that I collected. So there's a perfect live example of a covered call in action. Okay, I don't see any other questions in the chat box. Thanks everybody for being here. Look forward to seeing you again next time. Goodbye for now and good trading.